Welcome back to Investing Talk Podcast.
Today, we're looking at Beyond Meat.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For a long time, the narrative around this company felt less like a growth story and more like a high-stakes survival drama.
Well, completely. Going into the first quarter of 2025, the market consensus was, frankly, terrifying.
It was.
It really felt like the crisis point. You had this steady revenue decline, and all the scrutiny was warranted because management was being forced into these drastic, almost desperate cost-cutting measures.
Just to keep the lights on, really.
Exactly.
We're talking about eliminating, around 17% of the entire workforce? That's nearly 190 roles gone.
Wow.
And they weren't just tightening their belts. They were pulling out of huge international markets. Think about Japan and Australia, just gone.
So they were actively shrinking the company just to stop the bleeding.
And that sends a pretty chilling signal to the market.
Right. And the financial tension was immense. And then you had the personnel changes on top of it.
The CFO leaving?
Yeah, the CFO, David Lee, his departure in January. That always injects volatility when a company's already on shaky ground.
And everyone was looking at the cash position.
That was the biggest anxiety.
Yeah.
They were holding only, $101 million in cash?
Right.
Versus $185 million in debt that was set to mature through 2026. That gap felt enormous. The clock was ticking?
It really was. And the sentiment just fell off a cliff in March. We saw 6 out of 10 analysts drop their price targets. And the phrase you kept hearing was structural headwinds.
And that phrase basically meant the problem wasn't temporary, right? It was the whole sector.
Exactly. The whole plant-based industry was struggling against, cheaper conventional meat and just a general consumer pullback.
I remember the fear leading up to that May 7th Q1 earnings release. The whisper numbers were suggesting management might have to guide Q2 revenue below $50 million.
A level they hadn't seen since 2020.
Yeah, that was the line in the sand. Crossing that would have confirmed the death spiral narrative for so many people.
It would have. It would have confirmed the worst fears. But this is where the story just pivots so dramatically. This is the inflection point.
Okay, so let's talk about those Q1 2025 results because they really did shock the market.
They absolutely did. Instead of the disaster everyone was braced for, revenue landed at $74.8 million.
And that wasn't just a beat. That marked the first year-over-year expansion in, 2.5 years?
2.5 years. 12.7% growth. That revenue reversal just fundamentally changed the investment thesis overnight.
And when you dig into where that growth came from,
it's even more encouraging. North American retail sales surged 18.3%.
Wow.
Which confirms there's still strong consumer pull, despite that whole structural headwinds narrative.
And international wasn't dead either.
Not at all. It hit 31.2% growth, mostly driven by strong performance in China and Europe.
What I found most encouraging, though, was the structural shift toward profitability. Retail now makes up 68.4% of their total sales.
And that shift is absolutely crucial because the retail channel just has much, much higher margins than those food service contracts.
So they're selling more of the stuff that actually makes them money.
Precisely. And even the food service segment, which was the anchor dragging them down, it rebounded by 7.1%.
And that wasn't luck, was it? It was new contracts.
No, it was pure execution. You've got Starbucks rolling out that new plant-based breakfast sandwich and Dunkin' expanding the Beyond sausage to all its U.S. locations.
Those are massive deals.
Huge volume contracts that provide a stable floor.
Which leads us right into the most critical part of this turnaround.
Yeah.
The financial discipline and the margin expansion.
Yes.
Because growing revenue is one thing, but if your unit economics are broken, you're just, accelerating the cash burn.
They fixed the core. That's the story here. And the gross margin improvement is the clearest signal that the plan is actually working. It expanded to 28.1%.
Which is a huge jump, a 680 basis point improvement year over year. So how'd they do it? What were the levers they pulled to get such a dramatic flip?
Okay, so there were 3 main drivers. First, the tough one, supply chain rationalization. They consolidated manufacturing from 5 facilities down to 3.
That's huge. That must have slashed logistics costs.
Drastically. Second, they benefited from input cost deflation. Soy and pea protein costs dropped 19%.
And that wasn't just luck with the market, was it?
No, that's a great point. It was also strategic. Management signed some really smart long-term fixed-price contracts last year, so they likely locked in better rates.
Ah, so they bought themselves some certainty in their cost structure. That's a huge competitive advantage over rivals just riding the spot price.
It absolutely is. And the third driver ties back to what you said, the product mix. They are successfully shifting focus to premium items.
Like the Burger 2.0 and the Sausage Deluxe.
Exactly. Those higher-tier products now make up over half their SKU volume, which naturally lifts the average selling price, and most importantly, the margin on every single unit.
And on the balance sheet side, things improved really quickly. Cash actually increased a little to $102.4 million.
Which is stability. And right now, stability is a huge win for them.
More importantly, their net debt to EBITDA ratio improved to 2.1x. So for our listeners, that basically means their operating income is now strong enough to cover their entire debt in just over 2 years.
It's a much healthier leverage position. It puts them back in a safer zone, and it bought them runway. They have no significant debt maturities before 2026.
And the cash burn is finally slowing.
Finally. They cut their negative free cash flow by 43% year over year. The burn rate went from over 32 million down to about 18 million.
So this performance is what let them raise their full-year guidance so significantly, right? To between $355 and $375 million.
Yes, and to confidently reaffirm guidance for positive adjusted EBITDA by the second half of 2025.
Okay, but hold on. This is a company with a history of, let's be honest, overpromising. Why should we trust this guidance now? What's different?
That skepticism is totally fair, but the confidence this time seems to be tied directly to that structural margin improvement.
The 28.1%.
Exactly. That wasn't a lucky break. It's proof the painful cuts they made are actually working. They're now projecting to keep gross margins above 25% for the rest of the year.
And that's the math that gets them to positive EBITDA.
That's the math.
Okay, that shift is why the stock reacted so dramatically. So let's talk about their competitive moat. In this space, you need one.
And theirs isn't just marketing. It's proprietary protein structuring IP protected by 7 U.S. patents.
And that IP is their secret sauce.
It really is. The tech in their premium products, like the Burger 2.0, is fascinating. It uses something called microscopic collagen mimetic fibrils.
Okay, break that down. What does that actually mean for someone eating the burger?
So it's pretty technical, but basically, they are engineering plant protein at a microscopic level to mimic the fibrous, chewy structure of animal muscle.
That satisfying pull you get from real meat.
Precisely. Replicating that is incredibly hard. Their IP lets them do it uniquely well.
And we've seen market validation for that, right? The Roush Labs test.
Yeah, that 2025 test showed 83% of consumers preferred the Beyond Burger 2.0 over a key competitor, and they specifically cited chewing texture and juiciness.
So the IP is translating directly into a better product.
It is. And it's important to contrast their approach with, say, Impossible Foods. Impossible relies on heme, which gives that bloody look.
But that's also led to ongoing FDA scrutiny.
Right. It requires extra data. It can delay scaling. Beyond's all-plant, non-heme approach just sidesteps those headaches. Their regulatory compliance is solid, which is a real edge.
And the market sentiment has definitely caught up to this. The analyst consensus has flipped.
Dramatically. 6 of 10 now rate it buy or higher. Cantor Fitzgerald upgraded to buy, specifically citing the IP and the strong retail performance.
And the institutional money is moving in. Vanguard increased its position by 40%.
40%, and you've got BlackRock and Dimensional Fund Advisors also emerging as major holders now.
That's the smart money showing conviction in the long-term turnaround.
And it's not just institutions. We're seeing confidence from the top. The CEO, Ethan Brown, bought 20,000 shares in March.
His first insider buy since 2022. That's a huge signal.
This CFO bought in April, too.
Right.
And then you have the technicals.
The Golden Cross.
Yep, in April. The 50-day moving average crossed above the 200-day. For those unfamiliar, it's basically a big technical sign that short-term momentum has overtaken the long-term trend.
A signal that the worst is likely over.
Exactly. And looking forward, there are some really clear catalysts lined up.
The Costco deal.
The Costco deal is the big one. An exclusive North American retail deal for their Beyond Sausage Deli line.
That's launching in Q3 across over 600 locations. That is a massive, high-volume opportunity.
Huge. Then we have the Q2 earnings call in July. The consensus is already high, around $87 million in revenue. That's the next big test,
And then the Investor Day in August.
which should be critical. They're expected to announce their roadmap for a cell-cultivated meat partnership and detail new products like plant-based seafood and deli slices,
Expanding beyond just burgers and sausage.
capturing whole new consumer segments.
Okay, so with all this optimism, we have to talk about the downside risks. What are the bears still worried about?
Two main things. First, potential margin pressure from retailers. As they get bigger with partners like Costco, those giants have leverage to demand more promotions.
Which could squeeze those margins they just fought so hard to win back.
Exactly. And the second risk is just consumer demand elasticity. Plant-based is still more expensive if conventional meat prices drop significantly.
That price gap widens, and it could definitely hurt their volume growth no matter how good the burger tastes.
Right. But management seems very aware of this. They're talking about moderate promotional discipline. They believe their recent growth is driven by taste and convenience, not just discounts.
And the downside seems pretty priced in at this point.
I think so. The stock is still trading below the valuation of many private peers, which suggests a lot of that risk has already been discounted by the market.
It is a truly dramatic reversal. I mean, we went from fearing sub-$50 million quarters to expecting positive EBITDA in just a few months.
The challenge now shifts entirely from survival to execution. They have to keep this margin trend going, leverage that IP, and capitalize on these new retail deals.
Especially that massive Costco launch. If they hit positive adjusted EBITDA by the end of 2025, the narrative changes from turnaround attempt to sustainable recovery.
It does.
So here's a final thought for you to chew on. Given that their IP gives them a real texture advantage, can they leverage that superiority to eventually justify a true price premium? Or will the mass market always force them to compete on price with conventional meat?
That question will define their long-term value. The next 12 to 18 months will be absolutely critical for the execution of this turnaround. And if you want to stay updated on how they do, make sure you subscribe to Investing Talk podcast. We'll keep tracking it for you.